Today we are going to talk about the Great Recession that happened from like 2007 to 2009. And can you believe we have come all the way from settling the Americas to 2007, 2009. This course has just given us a nice broad overview of American economic history with some Chinese economic history thrown in there. So this has been fun. I hope you've enjoyed these classes. But today we want to get to the bottom of what happened in 2007 to 2009. This is especially important because many of you watching this lived through this. In fact, all of you watching this should have lived through it. I can't imagine that I have 10-year-olds watching this video right now, but hey, if you are, go ahead and subscribe. But this is something that you have lived through, and yet you probably don't understand very well. Here is a graph that shows our GDP over time, and you can very clearly see when that recession happened and how it has affected the long-run growth of the American economy. Just as wild is this graph of unemployment, where you see this huge spike in unemployment, one of the biggest we've had since the Great Depression, though of course I believe in the 2020 we surpassed this thanks to the pandemic. But this is pretty wild to think about these big changes that have happened. Now, the pandemic is something easy to understand. The economy shut down, people lost their jobs. What happened in 2008? Why were the people losing their jobs? Why was the economy going under? You probably have something like the housing market in your mind. Well, the housing market is there. It's a part of this, but it's not the full story. I'm not going to be able to give you the full story. There are so many tiny details involved in the Great Recession. I'm not going to be able to give you a huge, in-depth view into this. But what I can do is at least introduce you to some of the concepts and principles that will help you understand what happened during the Great Recession. But to fully understand this, we need to go back and understand what has happened to the Federal Reserve since the Great Depression. Because if you remember, the Federal Reserve was largely responsible for what happened during the Great Depression. What has happened since? What have we learned? Where are we in 2007 with the Federal Reserve? Well, one of the big developments with the Federal Reserve happened in the 1960s when Milton Friedman and Anna Schwartz published A Monetary History of the United States. As far as I can tell, this was the first argument that the Great Depression was caused by the Federal Reserve. A lot of different causes were discussed at the time. It was very misunderstood, and Milton Friedman and Anna Schwartz come out and say, it was the Federal Reserve, and they go out and they track monetary policy, and they have all the models with monetary policy, and they say, look, this is clearly what caused the Great Depression. And people weren't 100% convinced by this, by no means, but it really did change the perception of how money affects the economy. There are a lot of economic models that don't take money into account. And you say, like, what does that mean they don't take money into account? Of course, money is important for the economy. Well, in some ways, it doesn't really matter if things are priced at $10 and $5 versus $20 and $10, right? The ratio of prices is 2 to 1. The money shouldn't matter. That might not have been a very clear one. How about, it doesn't matter if our economy is in pounds, British pounds, or US dollars, or Japanese yen. The economy is functioning no matter what type of money we have, right? So money shouldn't matter that much. Well, turns out that money does have an effect on the economy, and this was one of the big arguments saying the Federal Reserve, if not run properly, can cause a lot of harm. Well, that's an academic argument, but the probably more convincing aspects were some of the practical things that happened in the subsequent decades with the Federal Reserve. Let's get to inflation in the 60s and 70s. We started to see some really high inflation in the 1960s, and there were several reasons for this. There were large tax cuts, there was expansionary monetary policy, there was low unemployment, Vietnam War, lots of government spending, lots of things that were just causing high circulation in the economy, causing more inflation. In the 1970s, President Nixon tried to limit this inflation through price controls and wage controls, but it just wasn't working. Then in the 1970s, OPEC, which is the big oil cartel in the oil-producing countries of the world, had an oil embargo where oil prices shot through the roof because supply was restricted. And that had these huge inflationary dominoes because so much of the economy relied on oil. Now, usually some inflation at least pushes economic growth, But we weren't seeing economic growth. We were seeing high inflation without growth. And people call this stagflation, where you have a stagnant economy with high inflation. Here's the inflation rate over time, and you see that it's just going up and up into the 1970s. And this red line right here is when Paul Volcker becomes chair of the Federal Reserve. And shortly thereafter, you see the inflation rate fall. What happened after Volcker became the Federal Reserve chair? Well, Volcker becomes chair in 1979, and during his confirmation, he makes it very clear that his policy is to go for contractionary monetary policy. He wants to bring inflation down, and he says the Federal Reserve can do it if the Federal Reserve is tough, if we put a lot into bringing these inflation rates down. So he tightens monetary policy, he causes a slight recession, and people start panicking. This is something that people were not excited about, even with high inflation. They're like, wait a second, we don't want a recession. But shortly thereafter, because Volcker held the course, the inflation ended. Like the recession, they came out of that short recession, they had low inflation, everything was much better on the other side. And this really demonstrates the importance of having independent monetary policy. A lot of politicians were pressuring Volcker. A lot of people were upset about what Volcker was doing, but he had clear-minded goals. He understood what he needed to do. If he had succumbed to that political pressure, he would not have carried out the monetary policy necessary to make sure that our country could get out of that economic quagmire. So Volcker, as Federal Reserve Chair, really cemented our understanding that the Federal Reserve can do big, important things. After Volcker's tenure, we had Alan Greenspan, who took charge in 1987, and Greenspan was a superstar. A superstar in terms of he understood how to work the camera, how to work the Federal Reserve. There are a lot of things. We're going to talk about Greenspan's shortcomings, but he understood how to reach out to the people. He had a real penchant for media. He dated Barbara Walters. He eventually married another journalist. He just understood how the media worked. Not only does he understand media, he starts off with this big win where there's a stock market crash and he handles it really well. The Federal Reserve responds quickly and properly. The stock market crash had hardly any effect on the economy. Then over his career, he served in the Federal Reserve for a long time, and over it there were so many different shocks. We had that first stock market crash, we had the fall of the Berlin Wall, 2 wars with Iraq, 9/11, the emergence of China, so many different things happening, and yet the US economy really went through this pretty well. Like even the stock market crash for the tech bubble in the early 2000s, that was a big blip and that hurt, but then we recovered from that really quickly. And a lot of people credited Greenspan's economic vision, his ability to understand what the economy needed and how to run monetary policy, for getting us through that. So in 2006, when he retires, he is a superstar. People love this guy. He's at the top of his game. People just think this guy is a wizard. So the 10 years of Volcker and Greenspan really just brought us to understand how powerful the Federal Reserve can be in shaping the economy. In fact, it became so well understood that it was powerful that people started hanging on to every word that the Federal Reserve Chair would say. They wanted to make sure, does he think the economy is going to go up or down? If I understand what he's going to say, then I can go into the stock market or I can make investments that are going to, come out really good for me because I saw what this economic guru saw. And Greenspan takes this and he starts speaking really obtrusely. He doesn't speak clearly. They call it Fed speak or green speak, where he's just very vague about what the Federal Reserve is doing because he doesn't want to trigger people to just suddenly go out and make investments based on the wrong word that he used. In fact, today, all public statements made by somebody on the Federal Reserve Board are just available on the Federal Reserve's website because they don't want anyone to have inside information and start making trades based on something they heard a Federal Reserve Board member say. Now, while Greenspan had a great tenure and he did a lot of amazing things, it was not without shortcomings. And now, in hindsight, when we look at what happened in 2008, we know that Greenspan had 4 major failings. First, he held interest rates too low for too long. When interest rates are low, you don't have good options when you're saving in banks. You start looking for riskier investments that you can go put your money in to bring up your returns. And so people started looking for riskier investments. And even with housing housing had a nice return, which we'll talk about in a second. When interest rates are low, it makes housing a really easy investment to make. And so we had a lot of investment possibly going to places where we shouldn't have had it going because interest rates were really low. Speaking of housing, the second failure was that he failed to act on the housing market. He was aware that the housing market was looking like it was in a bubble, but he described it as a froth rather than a bubble. Now, froth is just a collection of little bubbles, right? If you think a large bubble, you keep inflating it until it pops. Well, froth is just a bunch of little bubbles, and they pop individually, but it doesn't pop the entire thing. And when you think about how the housing market works, you have all of these local housing markets. The housing market in Logan, Utah is really different than the housing market in San Francisco, California. And if something were to happen in Logan, that doesn't necessarily mean that something is going to happen in San Francisco. So that you can get small bubbles apart from each other. One might pop, but the other one could continue. And so because he saw this as a bunch of little bubbles, he didn't want to come in and intervene. Plus, he had this idea of a mop-up strategy where it was better to come in afterwards, after things had settled, rather than intervene before it was understood that it was necessary. He was worried, hey, we come in and intervene, and in this counterfactual world where we don't intervene, everything was fine, and it's better to have non-intervention and intervention, so we should just intervene when we know that there's a problem rather than when we think there's a problem. The third failure was that he failed to regulate the subprime market. We're going to talk about subprime lending in a little bit, but the subprime market was going really into the shadow banking market, which again, we're going to talk about shadow banking in a second, but the idea is it was outside of regulation. And while they understood that this was happening, they just didn't think that this was a big deal. And because they didn't think it was a big deal, they failed to grasp how important this was for the economy. And that ended up leading to the big housing crash and after the housing crash, all the things that happened. We're going to talk about that in just a second. But he could have acted on that and he didn't. And the fourth was that he put too much faith in the free market. He was a very free market oriented economist, and he had strongly held beliefs that the free market would do a really good job regulating itself. Now, in many cases, the free market does. I don't want to knock the market because we do a lot of good things in making sure that we regulate ourselves. But sometimes we do need regulations. It's understood that there are certain situations that arise, and we need to recognize that that's when we need regulation. And he just thought, no, it's better to err on the side of no regulation than regulation. So, it's hard to argue on this one because I can see where he's coming from, but at the same time, we want to make sure that when there is regulation needed, that we actually put it in place. Okay, so I brought up shadow banking. Let me explain what shadow banking is. It sounds dark and spooky and something that is not good for us, but all it means is that it was banking that was happening outside of regulation. This is what we saw in the panic of 1907. Remember, we had the trusts and the banks. The trusts were the shadow banking system at the time. They were outside of regulation. They didn't have to follow the same rules as the banks, and as a result, a lot of things were happening there. And when things went wrong, then we didn't have a bunch of safeties in place to make sure that that failure didn't cascade to other places. Well, same thing's happening in shadow banking in 2007. We had this large financial institution, financial structure, all these things going on. So I guess I should mention what a shadow bank is. So when you think of a bank, you're thinking of a regular commercial bank usually. You're thinking like Zions Bank or Wells Fargo. Those are regular banks that are regulated. A shadow bank in 2007 would have been something like Goldman Sachs or Lehman Brothers, these big financial institutions that are helping people with IPOs, that are helping with subprime lending, and as a result, they're involved in financial activity that is outside of the regular purview of regulation. Also, let me make sure you understand a term that is important for this. It's leverage. Leverage is talking about how much debt versus equity you have. Again, this harkens back to some of the lectures that we talked about, other financial crises, where remember in the 1920s, people had a lot of debt as they were buying stocks. They had taken out huge loans, had put just a little bit of money down, and as a result, they were getting huge returns when the stock market was doing well, but when it started to fail, they were exposed to massive losses. So when you think about leverage, think about how a lever allows somebody to take a small force to act on a larger force. Now, of course, there's like a whole distance thing. I don't know if it's a full metaphor, but the idea is you can move something as long as you have the right lever. And this is what's going on. You have a little bit of force over here. You have a little bit of equity. You have a little bit of skin in the game, and you're using that to move a lot of finances over here. And that's what you should think of leverage, is how leverage are, how much is the force pushing down versus the force pushing up over here. So in 2007, the housing market was incredibly leveraged. Just like in the 1920s, the stock market was incredibly leveraged. And what I mean here is that there was a little bit of money down on houses. People would buy with just a little bit of money in, and they would take out huge debt to pay off the rest of the house. How did we get to that point? How did the housing market get so leveraged? Well, one thing is that homeownership has been a long-standing goal for US policy. And it makes sense, right? We want people to be able to own their homes as part of the American dream. And government policy has looked for ways to allow people to own homes. But to get everybody to own homes, that means we need the low-income households to own homes. And for that to happen, we have to overcome 4 barriers. First, we have to overcome the fact that low-income households often don't have money for a down payment. They can't actually put money on a house because they're low income. By definition, they can't put that down. 2, there are problems with credit history. Like, they often don't have a credit history because they're not used to taking out loans, or they have not very good credit histories because they might not be paying back loans. 3, there's not a proof of income. So when you buy a house, they're gonna ask you for proof of income to show that you can actually pay for the house that you're buying. And a lot of low-income households might be in a place where it's hard for them to prove their income. And 4th, there are just other information problems where we don't know if this is why are you low income? Are you a trustworthy person? All these information problems are really hard to overcome. And when you're high income, there are lots of ways for you to resolve it. Just by having high income, you blow past a lot of those information problems. But for low-income households, they really face a lot of barriers towards overcoming those information problems. So a subprime loan was a new financial instrument meant to overcome a lot of these barriers. Now, these loans were targeted at low-income households to make sure that they could buy the houses that they needed. Well, low-income households don't have money to put a down payment, and so these loans didn't have very high down payments, which by definition meant that these were highly leveraged loans. Now, one of the reasons why this was permissible is because housing was seen as an incredibly safe asset. In fact, there's a phrase, as safe as houses. It's been around for centuries. People have said, like, this investment is as safe as houses because there's always demand for houses, right? Like, people need a place to live. If you buy a house, it's always going to be a good investment. And so while investing in the stock market is, there are lots of things that go wrong, housing is always safe. So it's fine if we create this financial instrument that allows people to be highly leveraged when they buy houses, because housing will always be fine. At least that's what people thought. Now, not everybody thought this. There's an economist named Bob Shiller who looked at housing prices and said, I don't think housing prices really match what their true values are. It looks like people are getting a little bit optimistic about this, and they're creating a bubble. In fact, you can actually see his index that tracked housing prices to look for a bubble, and you could just see the massive rise in this index in the early 2000s as people were buying houses highly leveraged because they could put just a little bit down, they could afford to pay higher prices, and as a result, prices just kept going up. And it's this vicious cycle that just keeps driving up. This definitely looks like a bubble. Now, there's a problem with these loans, right? Like, they're highly leveraged, which means there's hardly any skin in the game. There's a lot of debt versus the equity, and they're to really risky households. Who in the world is going to give people this money? How in the world are you going to finance these things? Sure, it's safe as houses, but there's still risk, and this is the riskiest way to invest in houses. How do you get people to finance these loans? Well, the key to this was pooling the loans together. An individual loan might be risky, but if you were to pool a whole bunch of them together, the risk kind of balances out. Sure, one of them might fail, but it's really unlikely that lots of them will fail. So investment banks, these shadow banks, they started pulling together these loans. They made these securitized loans, which means they were just making it tradable, where you could buy into a pool of loans and you would be just paid the return of people paying back on these loans. Now, in some senses, this is nice because this gives people an opportunity to finance loans that normally wouldn't be financed. People are getting homes as a result. This is an innovation that's leading to the policy that we had set out. But pooling these loans relies on two assumptions. First, the default risk is not correlated across loans in the pool. So this only works if one person fails. It doesn't tell you anything about everyone else failing. It's all independent. It's like rolling a dice, right? If I roll a 6 on a die, that doesn't tell me anything about the other die that I roll. So it's fine if one person fails as long as no one else fails. But if they're connected in some way, or if their risks are correlated, this creates a huge problem, because one person failing then means that there's a good chance that a lot of other people in that pool are failing too. The second assumption is that investors know which securities are the risky ones. You know if you have bought something that's a risky asset, and you know that, you know the chance that you're not going to make your money back, and so you can properly price that in. But what happens is this housing bubble pops. Suddenly housing prices start going down. You have all these really leveraged people. It's just like the stock market crash in 1929, right? Like, you have all these leveraged people. They realize that they're going to lose a lot of money. They start selling, and as a result, it just like cascades. People want out of these securities. They don't want to touch them. And furthermore, they don't know if they have risky securities. Everything is poisoned, right? It just doesn't make sense to them to hold on to this. And so people want out of this. And so this market, the subprime loan market, and the securities that are backing them, they just start falling apart. So that is the first step of the housing market collapse and the Great Recession. But just like the crash in 1929, that is not the full story. It's important for you to understand what comes next to understand why we had such a big recession. First, you need to understand that, as I said, Greenspan retired in 2006, so we have a new Federal Reserve Chair. It is Ben Bernanke. Ben Bernanke is this academic type. Like, he came from Princeton to come work at the Federal Reserve. He's not a media superstar like Greenspan. He's not some experienced government policymaker like Volcker. He's just an academic. In fact, he had spent his entire life studying the Great Depression, which is pretty amazing when you think about it. The person who is the Federal Reserve Chair in 2006, just ahead of one of the biggest recessions in US history, is a student of the Great Depression. And not just a student of the Great Depression, his studies was specifically what the Federal Reserve could have done to avoid the Great Depression. So in 2007, we almost make it through. Like, we have this housing bubble pop, things aren't looking good, but hey, like, we understand where things are going, we can get out of this. But the problem is, so much of the problems in this financial system were happening in the shadow banking, outside of regulation. Bernanke and the Federal Reserve just didn't understand the full extent of the problems. And the real problem comes in October 2008. It always comes in October. Panic of 1907, Great Depression, Great Recession, always in October. But to understand what happened in October, you need to understand what happened in March 2008 with Bear Stearns. Bear Stearns was a large investment firm with tons of connections in the shadow banking system, but it was not very well run. It had poor leadership. There's lots of articles back then talking about how bad the leadership was, and it was highly invested in subprime lending. They just had so much of their assets in subprime lending, and they were very connected to the rest of the system. So in March 2008, Bear Stearns' debt is downgraded. Credit agencies are saying this is not a good company, that's not likely that you're going to be paid back if you own their debt. Well, of course, people don't want to own Bear Stearns' debt anymore, and people don't want their money in Bear Stearns, so there is a run on Bear Stearns. Not a physical run like we saw in the Great Depression, but people are calling up and saying, I don't want my money in Bear Stearns, get it out of there. Well, just like bank runs, this becomes a self-fulfilling prophecy where people are worried that this institution is going to collapse, so they pull their money out, and as a result, the institution actually collapses. Well, Bear Stearns is panicking, and they're looking for help, but the problem is they're a shadow bank. they're not in the Federal Reserve System. They're not protected by Federal Reserve mandates. So they're looking for a buyer to rescue them. They need somebody to come in and buy them up so that way their money is safe, their business can go on. But nobody wants to buy them. They're calling up the Federal Reserve and saying, please help us. We are going to collapse. We're connected with all these people. We need you to help us not fail. So the Fed lends Bear Stearns money to survive for a week. This is huge. Again, they're outside the Federal Reserve System. And yet the Federal Reserve is coming in and intervening and giving them a chance to make it through the week. This is unprecedented. This had never happened before. People are wondering what Bernanke is doing. Well, then the Fed, in this giant twist of irony, helps JP Morgan. Not JP Morgan, the person who helped save the Panic of 1907, JP Morgan, the bank that's named after him. They helped JP Morgan buy Bear Stearns, but the Fed takes on most of the risk. This is not a very good deal for the Fed. So this is just unheard of. Like, one of the things with monetary policy and with the Federal Reserve is that you need to understand what's going on and you need to understand consistency. Otherwise, it just makes things so hard to predict in the economy. And here we have the Fed doing something unprecedented people had never done before. But Bernanke, being a student of the Great Depression, knows that when you have interlinked banks fail, it comes through and it has systemic failure. It goes through and affects all the other banks in the system too. So he knows he needs to stop this failure. Well, that sets us up for October 2008 with Lehman Brothers. Now, Lehman Brothers is basically the same story as Bear Stearns. A large financial institution, in fact, it's like twice as big or something, very linked in with the rest of the system, and highly leveraged into the subprime lending market. Well, in September 2008, Lehman Brothers is barreling towards failure, and they're calling up the Fed and saying, hey, remember that deal you did with Bear Stearns? We're gonna need your help on that too. So the Fed, lets people know, says, hey, try to buy up Lehman Brothers, but people are just not interested in buying. At least not without a significant subsidy from the Fed like they did for Bear Stearns. Well, Bernanke looks at this and says, we cannot create this pattern. We cannot just constantly put all the risk on the Fed and come in and bail out all these companies. And so they let Lehman Brothers fail. Bernanke says we just have to let Lehman Brothers fail because there's no way for us to set this precedent. Well, this is a huge shock. Confidence in the market just disappears. People are like, wait a second. If you stepped in and rescued Bear Stearns, but you didn't rescue Lehman Brothers, who's safe in this economy? What's going to happen? And people start to panic. And not only the panic, like the lending stuff, they're worried about putting their money out there. They're worried about losing everything because they trust the wrong financial institution. So that's really what leads to the Great Recession, is the failure of Lehman Brothers in October 2008, which causes this massive panic as people don't understand what's going in the economy anymore. And this is, it's so hard because Bernanke is trying as hard as he wants to save the economy. He's doing his best, and we're going to talk about a few more policies, but at the same time, this miscommunication ends up being one of the biggest problems with the Great Recession. Could they have stopped the Great Recession if they had saved Lehman Brothers? I mean, it's so hard to understand the counterfactual. What comes next if you save Lehman Brothers? Do you just constantly save every firm, even though you're not even technically allowed to come in and do this? Hugely controversial, so hard to understand what the best course of action was at that time. Nowadays, referring back to 2008, you'll hear a lot about bank bailouts. People coming, oh, these banks all got bailed out and they were saved from this while people had to live with their own decisions. I don't know all the political rhetoric, but you'll hear about bank bailouts. Well, they're referring to TARP, the Troubled Asset Relief Program. After Lehman Brothers failed, the Fed and the Treasury were worried that more financial institutions were going to fail. So they needed a way to stabilize it. So TARP was this $700 billion fund that the government put in and injected directly into the market to try and stabilize these banks. And just like the rhetoric today, this was super controversial at the time. People were like, wait a second, these banks made risky investments that are about to fail, and yet you're injecting this money trying to save them? Why? And one of the things that they did was make sure that the 9 biggest banks all participated in this deal. They didn't want any stigma attached to taking money from this deal. So they took the 9 biggest banks, all of them were pretty safe. They're like, look, you have to take money from us, so that way everybody else recognizes that taking money from this fund is not a sign that you're a weak bank. Now, key thing here is that this was not free money. These were loans that the government was making to banks. Was it cheaper than they could have gotten on the open market? Yeah, probably, but they still had to pay interest on it. In fact, the government made money on every loan that they made to these banks. In fact, the places where they lost money were when they tried to bail out failing auto companies at the time. So that is the immediate action that the Fed and the Treasury were doing to try and save the economy. Well, what happens in the aftermath? Of course, the first thing the Federal Reserve does is lower interest rates. Now remember, the Federal Reserve does this by putting money into the system. They do this through open market operations where they buy back T-bills and they put the money into the system. This is called open market operations. But lowering the interest rate only works if that money then gets to the people, right? This is open market operations gets money to the banks, and then the banks are supposed to get it to the people. Well, remember, we have this reserve requirement where you're supposed to hold on to 10% of your liabilities in your safe, so that way you can, if you start to fail, you have something to rely on. Well, here's a graph of excess reserves from the 1980s all the way up to 2008. And you see that, banks generally, they have some extra cash on hand and it fluctuates with the economy. This is the state in 2008. Well, after that, this is what excess reserves looks like. All those fluctuations we just saw from the 1980s to 2008, they look like a flat line here compared to the excess reserves that banks were holding after 2008. Now, the reason is banks are terrified that they're gonna fail. They've just seen big banks fail. They're worried that they're also going to fail. And so instead of lending this money out, they're holding on to it to make sure that if they fail, they have that cushion to stop them from falling. So that's one problem, is that this money is not actually getting out to the people. The second problem is that interest rates can only go so low. You can cut interest rates to 0%. And that's what the Federal Reserve had done. They'd hit 0%. What are you supposed to do after that? So the Federal Reserve was running out of ammo, some people say. But Bernanke, he looks at it and he says, you know what? We've not run out of ammo. We need to resort to unconventional monetary policy. We're going to come up with new tools that let the Federal Reserve help the economy. The first of these was quantitative easing, or QE. And you hear about this all the time nowadays, at least you used to. I don't know if you hear about it as much anymore, but quantitative easing, so much of the stuff was super controversial. Quantitative easing is another way of trying to get money out directly to the people rather than going through the banks. With quantitative easing, instead of just buying T-bills, the Federal Reserve started buying all sorts of debt. They started buying, so we normally get short-term T-bills, they were getting long-term T-bills, corporate debt. They were buying up the mortgage-backed securities that were causing this whole thing. They're trying to get credit markets working again. And quantitative easing seems to have worked. I think we're still trying to understand the full effects of it, and some people say we haven't experienced the full effects of it yet. Of course, other people say, hey, if we had done more quantitative easing, we would have actually gotten out of this quicker. The second unconventional monetary policy that the Fed started acting on was called forward guidance. This was the idea that instead of being obtruse, remember Alan Greenspan, he didn't want to let anyone know what he was thinking. He was worried that people were gonna act on any little word. Well, Bernanke flips this and he says, I'm gonna be super clear. I'm gonna tell you exactly what I'm gonna do. We're not moving our policy until we achieve these goals. So they had forward guidance, was trying to be very, very clear about the Federal Reserve, what they were going to do, so that way people would act with confidence, knowing that nothing was going to change immediately. And the nice thing about this tool is that it's costless. At least you're not increasing debt, you're not changing the Federal Reserve's balance sheet, you're not putting money into the economy. All you're doing is just trying to be clear about your intentions going forward. Now, the recession officially ended in 2009, but the recovery took a long time. It took a decade to finally get back on track with where we were before the recession. It's called a lost decade of sort. And of course, the pandemic is threatening to remove all of those gains. But on the other hand, what we learned during the recession largely informed our policy when we were going forward with the pandemic. Jerome Powell, chair of the Federal Reserve, he saw exactly what had happened back in 2008, and he knew what he needed to do in 2020. And so a lot of people look at the Federal Reserve in 2020 and say, they worked really well. They were one of the most competent organizations and responses to the pandemic. So we learned a lot from the recession.